Good afternoon, everybody, and welcome to today's webinar, Spring Forward with Q1 Insights and Tips for 2024. I want to welcome our speakers today, Krista, Kerr, and Frank Settino. They're going to be exploring the latest market updates, emphasizing the current market conditions and the geopolitical trends as we move into spring and beyond. They'll be giving us some practical insights and investment tips and strategies for your consideration. We will then conclude with a detailed Q&A session, which we welcome you to participate in. Just a reminder, if you look on your screens, you should see a Q&A icon. You can click on this icon, and throughout the presentation, you can input your questions. We'll be gathering them up, and when we go to our panel discussion at the end, we'll answer all of your questions, and any additional insights and comments will be provided by Krista and Frank. Just a reminder, at Kerr, our primary commitment is as a discretionary portfolio manager, and it's our fiduciary duty to our clients. We champion a disciplined long-term approach to wealth creation and preservation, and our philosophy emphasizes the significance of diversification across asset types, regions, and sectors. Furthermore, we prioritize a multi-manager portfolio strategy, handpicking top-tier investment managers with a range of styles to ensure the best outcomes. Allow me to introduce Krista Kerr. She is our CEO of Kerr Financial Group, which is one of Canada's leading wealth management firms. Under Krista's leadership, our firm excels at providing top-tier investment management services backed by strategic insights, catering to individuals, business leaders, and affluent families. She leads Kerr's investment committee, ensuring that our clients benefit from the most informed investment decisions. Additionally, she helms the firm's multifamily office division, focusing on multi-generational wealth stewardship for our high net worth clients and families. Outside of her core responsibilities, she's recognized as an authority in Canadian personal finance, often sharing her investment and financial expertise across various media. She also dedicates time to the arts community, serving on boards like the National Ballet of Canada and the Festival des Arts de Saint-Sauveur, where she contributes to their audit and finance committees. Next up is Frank. He's the driving force behind our Montreal investment management services. He has a solid foundation built from years managing portfolios with a deep understanding of the investment landscape. He's adept at helping clients achieve their investment goals. His 2-decade journey began at Tal Investment Counsel, where he managed both accounting and administrative functions for diverse portfolios. Over the last 15 years, Frank's been instrumental in guiding portfolio managers in security selection, serving as Vice President of Canadian Equities at a major Canadian financial institution. His collaboration with our financial and tax experts here at Kerr ensures that our clients receive a comprehensive, integrated analytical approach to investment management. Frank is a CFA as well as an alumnus from John Molson School of Business. So I'd like to invite Krista to turn on her video and mic, and she will begin with a brief introduction.
Hello, everybody. Nice to see you today. Really the purpose, as we've done in prior quarters, we've sort of started this path of having these webinars every quarter. And I think the real objective is to give you a little bit of a backdrop to what happened in the economy and the markets in the last quarter. So that gives you some context for your portfolio returns, but then to really think about, what factors are going to impact the outlook going forward from here based on what we've seen, and what do we then counsel in terms of portfolio positioning, sharing some of the insights we're talking about at the investment committee. So I'll be talking a little bit about what happened in the markets and our outlook, and then Frank will talk about some opportunities that we see. We wanted to start, as we have in the past, with a polling question. We always like to get a little bit of input from you as to, in this case, what some of the areas of risk could be going forward to make sure we sort of address some of them. And I think there's a number of these that you might see. You'll see the polling question on the screen. So as we look forward to the balance of the year, what are your biggest concerns? Are they relating to elevated interest rates? Are they related to geopolitical tensions, which have become more more alarming, I guess, as we go through with what's happened with Iran and Israel in the last week. What about inflation or some kind of a correction in the technology sector, which has been driving returns in the US, or the US political climate, or other? So just interested to see what you have to say, and then we'll try and address some of these in the session.
People are just inputting their information, so we'll give it a little more time.
The harder one this time, because they're all some valid thoughts.
Indeed, indeed, indeed. I think right now I'm the only one that gets to see what's happening, but soon the rest of you will too. All righty, I'm going to end the poll and I'm going to share the results.
And just because when you get a playback of the webinar, you don't always see the results. We have a number of people concerned about geopolitical tensions, I think just in general, but also on whether there's some impact from those on inflation and energy prices. That's 40% that we're seeing. We're seeing 24% US political climate, 16% about interest rates taking longer to come down, 12% worrying about inflation, which obviously impacts some of those other elements, and then a smaller number, 8%, thinking about the tech sector and the impact on overall returns. So I appreciate that input. There are, as I said, lots of things that we can be talking about in that area. So if we move forward from there, we'll talk about what we saw. So if you think about, just before we look at the specifics, in sort of big picture terms, and there were some regional differences across, from the US being very strong and, Japan being very strong. There's some differences across the global climate. But in general, we started to see slowing economic growth, but still positive growth. So we saw some economic growth, but a little bit slower than what we saw last year. We see inflation starting to trend in the right direction, but still higher than the targets that central banks have. And interest rates poised to start to come down, but at some point, a little bit unknown. So as we entered the year, I think a lot of people felt that the economic growth was starting to really slow and pull inflation down with it, and that was going to allow central banks to even cut up to 6 times in 2024. And the ... at some point here shows that we've had a little bit of an adjustment to that, which we'll talk about. But those are 3 sort of trends we're seeing across economies. And because of those things, because we're not seeing a jarring drop down, the probability of recession has lessened a little bit compared to what people thought at the end of last year. And so in general terms, the consensus for a soft landing scenario is higher than it was before. And with that backdrop that we have, global equity markets continue to show of strength. So they provided nice positive returns that we'll see. If we go to the next slide, we'll see a little bit of the economy. So in comparison to the thought at the beginning of the year that we would see declining economic growth based on those higher interest rates that we were absorbing, the economy, especially in the US, has been particularly resilient. So in the United States, we're still a little bit lagged in terms of measuring, but we recently got updated numbers for economic growth in the 4th quarter last year, upgraded to a 3.4% growth rate, which is well above the 30-year median growth rate of 2.6%. So the economy grew quite well in the 4th quarter. And where we don't quite have all of the Q1 numbers yet, the latest estimate from GDP now is saying about 2.8% growth, which is slower than the 3.4, but still a solid growth number. So the economy is still growing. One of the big supports of that, especially in the US, is a strong consumer. I think you'll see later on, we have a little visual that about 67% of GDP growth in the US is driven by the consumer. And the consumer still has a very strong job market and has been showing up, demand from consumers hasn't come down. So that's been very positive, and that has helped to drive the US economy growth. We've also seen some positive things like the Purchasing Manufacturers Index, which stayed above 50, which is expansionary territory, and the Manufacturing Index gaining as well. But then there were some areas where we're seeing some mixed results, and we have to keep an eye on those. So while the Manufacturing Index was up in March, the Services Index was a bit below forecast. Now that's what we want to see with inflation tapering, but it does impact growth as well. And then the biggest thing we have to keep an eye on is we're starting to see some signs of stress in terms of credit cards, auto loans, mortgage defaults, not into dangerous territory yet, but a little bit of warning signs there. And that could impact consumer strength, which, as we mentioned a minute ago, is a big part of the GDP growth. So generally pretty resilient numbers through the quarter, but some things to keep an eye on. This really talks to market highlights, and we're gonna show you a bar chart of returns in a minute. But basically, global stock markets were all positive in the quarter based on that positive economic growth, as well as earnings reports, et cetera. As a all-encompassing index, the MSCI All Country World Index was up 11.2%, so very positive returns overall. Behind that, the US has continued to be one of the strongest markets. The S&P 500 was up 10.2% in US dollars, and then because the US dollar strengthened versus Canadian dollar, the returns are even higher in Canada, about 13.5%. in Canadian dollars. And you can see in January and February, so you might remember us talking last quarter about at the end of last year, we started to see a broadening of returns. They weren't only coming from technology stocks, but in January and February, we sort of went back to seeing the biggest returns from those magnificent seven, those seven largest cap technology communication companies in the US. And those stocks as a collective, the seven stocks, were up 13% in the quarter, even though Tesla and Apple had some real price pressure downwards on them. The interesting thing when you think about the S&P 500, the 493 stocks that are not in the Magnificent Seven were only up 6% for the year, whereas the overall US index was up 10.2% in US dollars. So again, a lot of strength from those seven stocks. We did see in March things broaden out a little bit again. So while the quarter overall, we had strength in quality growth stocks, especially in the month of March, we started to see value stocks come back a little bit. So US stocks continuing to be a big driver. In Canada, the S&P TSX was up 6.6%, so a little bit more like the 493 stocks in the S&P 500 that weren't the large technology companies. We had the strongest returns in Canada, as you'll see we'll see the US sectors, but the strongest ones coming in energy, which has rebounded, had rebounded, as well as industrials and healthcare, and the weakest returns in Canada from the telecom services, the big telecommunications companies, which were actually down 8.5% in the quarter. The EFI, which is the Europe, Asia, Far East index, was up 8.7% in Canadian dollar terms. And some people might be noting that Japan had very strong returns in the quarter. The TOPIX was up about 18.1%, and that was offset by more modest returns in Europe to bring it to the 8.7% return in Canadian dollars. The emerging markets lagged a little bit, up 5.1% in the quarter, and that partially reflects concerns investors have about whether China's growth prospects continue to moderate. So they still have positive growth, but it hasn't been as big of an engine as we'd seen in the past. So that's a little bit about equity markets. The next slide talks a little bit about the fixed income, which was more volatile in the market, and it was impacted really by the changing expectations around rate cuts. So at the end of last year, as we mentioned, people were quite optimistic or quite confident that the economy was slowing, which doesn't sound like an optimistic thing, but the optimistic part of that is they felt that the market felt that that could support up to 6 rate cuts by central banks, which would provide a much more accommodative environment for companies going forward. So we thought at the end of last year, the market thought anyways, optimistically or over optimistically, that there might be 6 rate cuts in 2024 because of this persistence of resilient positive economic growth and central banks coming out with messaging saying that they may be happy with having higher interest rates for a longer period of time. That revised market expectations. And even before CPI numbers coming out last week, by the end of the quarter, the market was thinking that there might only be 3 rate cuts in 2024 in the second half of the year. With CPI numbers coming out even a bit stronger last week, there's still a thought that, maybe there could be 2 to 3 rate cuts in the year. So a big reduction in the expectation of the amount of rate cuts we would see and the pace of when that would happen. And because of that, we saw government bond yields rise in the period and broad bond indices drop a little bit. So the FTSE Universe Bond Index in Canada was down 1.2% in the quarter. When you think that some of that was driven by the expectations around interest rates, long government bonds would be the most interest rate sensitive. So the things that were impacted less or did a little bit better were short duration bonds. Shorter bonds were down less than longer bonds, and corporate bonds were better than government issues, which also reflected the fact that the market feels that balance sheets of companies are pretty strong. So that's something that we saw in that area. Corporate bonds slightly positive versus the index being down 1.2%. So then we have a few pictures to show you that continue that discussion. So this is our market returns. The bar to the far left in each category is the quarter return, the 1-month return. It's in purple for those who are seeing colors. And then the second bar from the left is the 1-year numbers. So they're in red, and that's the 1 year ended March 31. So you can see cash on the far left, we're still getting, almost 5% per year on cash. So 1.2% was sort of the average in the quarter on a 30-day T-bill. The bond universe, as we mentioned, was down slightly in the quarter, down 1.2%. Canadian equity, we had talked about being up 6.6% for the quarter and 14% for the past year. The US seeing that real strength, 13.5% in Canadian dollar terms in the quarter and almost 30% for the past year. And then international equity measured by the EFI being up 8.7% in the quarter and almost 16% for the 1 year. Emerging markets a little bit less, 5.1 in the quarter, 8.6 in the year. And then bringing all those together into a balanced benchmark. This benchmark includes 40% bonds and 5% cash and the rest equity, but it shows that kind of a balanced portfolio would have been up 4.4% in the quarter or 11% over the past year. So continuing to see some nice positive returns, especially in equity markets in the quarter. The next slide shows you the US sector, so a little bit different than Canada, but you can see again, communication services and technology are those big, impacted by those Magnificent Seven stocks. So those were both up quite nicely in the quarter, 15.8% for communication services, 12.7% for technology. Energy also had that rebound, which did impact positively Canadian returns as well. And financials also doing fairly well in the quarter. The one at the far right that has dipped a little bit is real estate, and that's really because it's quite an interest rate sensitive sector. So with the thought that rates may not come down as much, that impacted expected returns in that area. So that gives you a little bit of a flavor, and that also ties into this slide, which talks about the style, manager style. So as Kathleen mentioned at the beginning, we like to have multiple managers in our client portfolios to provide contribution from different areas. And part of that is trying to pair style of different managers so that it complements each other to reduce risk and enhance your returns, so enhance your risk-adjusted returns. The biggest factors in the quarter were quality and growth, again, building on those technology stocks that we talked about and the strength in the US. but value also being positive in the quarter, and larger cap being a little bit more positive than small cap, but all areas contributing to returns. So that gives you a little bit of a flavor of what's happening in the markets and the economy. One of the big drivers of all of that is inflation. And this graph really shows that in the big picture, we know we've had some stickiness in inflation that you saw, especially in some of the announcements over the past week. But in general, inflation has really trended in the right direction. If you think, sort of in 2022, we were hitting a peak of somewhere between 8 and 10% on inflation in various, depending on where you were in the world. That 8 to 10% peak is now down to about 2.75 to 3.5% at this stage. So it's definitely coming down in the right direction in a big picture term, which is good. So it is being managed, and that's giving some positive outlook. But there are some sticky aspects. So the next slide shows a little bit of the components behind the inflation readings. So you can see the way to read this. So core goods, if we start with goods, the dark purple in the middle, you can see that those bars were really increasing into 2022. And that was a period from 2021 through to the end of 2022, where there was concerns about the supply chain. There was more inflation being driven from the goods sector, and you can see that that's really fallen off now. So goods inflation has come down and actually been a bit of a factor in reducing overall inflation, and that's as these supply chains have regulated, et cetera. So that's a positive story. Services, on the other hand, which so if we go back there, yep, services, which is the beige bar, you can see has remained quite sticky, and that usually includes shelter, which is sticky. So the stickiest things are really wages and shelter, shelter being rent and housing, and that is starting to come down, but it always takes time. So it's a lagged indicator, but you'll see that services sector still being quite sticky. Energy, which is the orange bars, you can see has jumped all over the place. We had sort of deflationary impact from energy, and then we had inflationary impact, and then it dropped down again to be lower, and just in the last quarter started to be positive again as oil prices or energy prices went up. So that's been moving around a little bit. So I think, while we're seeing that trend of inflation coming down, there is still some area of the market where it's a little bit stickier, and that's making the inflation not quite come down to the target rate of 2%, which is sort of giving some pause to central banks. So good for us to keep an eye on it. I think the big picture is it is moving in the right direction, but it's maybe coming down a bit slower. Someone said when the Fed increases rates, they take an elevator up and an escalator down, but then it looks like right now they're taking the stairs down and not the escalator. So coming down a little bit more slowly. So the next slide sort of looks at what all that means on interest rates, because really the central banks really want to, maintain employment, but they also want to keep inflation in check. And so they don't want to reduce interest rates and have really hot economic activity that's going to heat up inflation more. So they're watching those data points very closely to decide when they want to start to reduce rates. As I mentioned, there was this expectation, which I think was overly optimistic, that the federal central banks, in the US and Canada were going to drastically cut rates in 2024 and maybe start as early as March and have maybe up to 6 cuts. I think that was overly optimistic at the time. Now we're looking at maybe 2 to 3 cuts towards the latter part of the year. But you can see on this graph, which is from JP Morgan, which looks at both the Fed committee expectations and the market expectations, you can see from the high where we are now, 5.38 in 2023, there is an expectation rates will come down. So they are going to come down, which will be positive, but it will take some time. You're seeing that that's not looking like a big drop to, to 2% and not coming back down to the 0% interest rates that we had. So rates are moving in the right direction. They will start to decline, but it'll take a little bit more time. And that's something we have to keep an eye on. So looking at all of that, what does that mean for the outlook? And then it'll lead into what we're doing in terms of positioning. So I think in terms of outlook, we do still have a relatively positive economic backdrop. So the economy is proving to be resilient. We're seeing growth, even though it's a bit slower. We're still seeing corporate profits being strong. We're still seeing job markets being strong. So that's all good news. But there are some things we need to keep an eye on. So we know that prices have continued to go up. You're seeing indices hitting highs, in the first quarter again after a strong 2023. So some parts of the market are really priced for perfection and will be volatile as new economic data is digested. So because the central banks are keeping an eye on that economic data and looking at when they're going to cut rates, that's going to bring new news cycles in, and that's going to impact the markets. And you've seen that a little bit in the beginning of April so far, that we've seen some market fallout. So I think that's one of the things we need to watch, that there could be some more volatility, and it's a reason why, as we'll talk about, we want to have diversification in the portfolios. The other thing that I think everybody's really conscious of, and this gets to the risks you guys talked about in the beginning, was the geopolitical risk. So we still have, the terrible situation with the war in Ukraine, which is really waiting for US funding, and hopefully we'll know a bit more by the end of this week about that. There's also the situation in Gaza, and now a new conflict between Israel and Iran. I think, some people feel Israel was able to really defend the Iranian offensive earlier this week, and that may mean that they're not in a rush. But I think Israel is still saying that they will retaliate at some point. Hopefully that will be contained. And right now there doesn't seem to be an impact on expectations over energy prices and sanctions that would impact energy prices and inflation, but it's something that could happen. I mean, hopefully the right decisions will be made around that, and the situation can be managed to some degree. But I think that's an area we all need to keep an eye on for sure. Earnings reports are still, the expectations are still pretty positive, but we'll be watching as the earnings numbers come out again to see if there's something else behind them that would change our outlook. And then one of the most important things, because as we noted, the US GDP growth was largely supported by the consumer, we need to keep an eye on consumer sentiment and those indicators around stress on auto loans and credit cards. Make sure they've risen, they haven't gotten to dangerous levels, but we need to keep an eye on that, because that does drive a lot. This is in the fourth quarter of last year. Where did the growth come from? And you can see 2/3 of growth came from consumption in the US. So if that engine turns off or turns a little bit, that'll impact the outlook for growth as well. So generally positive backdrop, which is good, but a lot of things for us to keep watching to make sure we're looking at, and then a lot of reasons why we want to be, cautiously optimistic and diversified in our outlook. So thinking about what does that mean for positioning, again, because we see that generally positive economic backdrop and the idea that eventually rates will come off, et cetera, we do continue to favor the long-term prospects of equities. Now, that doesn't mean we're moving portfolios entirely into stocks. We're still going to always have a strategic asset allocation that suits you and your objectives and your risk tolerance, but it means that we will continue to be a little bit higher on the equity range, which is where we've been positioned for a while, and that's been positive for portfolios. Because we think there could be volatility as new economic data is digested, we think it's really important to have diversified portfolios. So, obviously in hindsight, it would be great to have only been in US large caps in the last quarter. But I think it's important to have diversification to protect the risk adjusted returns of the portfolio. So that's diversification across asset class and geography and sector. So we believe that's important to manage volatility. With one of the thoughts that we've started to have within the investment committee is, while cash has been a great place to park money that you might need going forward, because we're getting that almost 5% on cash, if we anticipate that rates will start to fall off a little bit towards the end of the year, there may be a time where it's better to have a short duration bond to manage your liquidity over the next year. You don't want to lose money in the bond market, but if you think rates are going to come off, if you have a short duration bond, that might be an increasingly interesting way to look at holding some cash. So that's something we're talking about. On the positive side, the valuations are not uniformly high. So you can see again, those 7 stocks in the US have been really strong, but there are other parts of the market that are not as overvalued. So that gives our managers, the managers that we hire to work on the portfolios, some opportunities to selectively add to positions at attractive prices. So there are some opportunities in the market. And then similar to our diversification point, we want to have diversification in style to not to only be exposed to the quality growth, although we do favor that factor a little bit, but we do want to have a breadth of style in the portfolio, again, to provide you with the best risk-adjusted returns. And always remembering that we're really focusing on the long term. So sometimes there's going to be short-term volatility. We don't want that to drive the objectives. We want to have well-constructed portfolios that suit your long-term objectives. And then we just included this next slide a little bit to further illustrate the reason for diversification, I guess. This goes back to 2009 and up to the current quarter, and it looks at where returns were from different types of portions of the portfolio. So for example, the large cap stocks, which were very positive in 2023 and year to date 2024, you can see they're right at the top. They were also at the top back in 2009 and in 2019, but there are other times when they were lower in terms of favor. Oh, sorry, I was saying not in 2009, it was the average for the total for that one. But you can see that again in 2009, they were down a little bit in 2010. So that asset class has not always been at the top. And similarly, there are years when small cap stocks are really important to have, like in 2013, 16, 20. There's time where cash is important to have. There's times where real estate is important. So asset classes do contribute at different times, and that's just one of the reasons we want to, in order to provide you with the best risk-adjusted returns, we want to have that diversification. So we want managers that are going to provide contribution across styles, asset classes, geographies, sectors, and then we want to make sure they're looking for those opportunities for stocks that have, that where valuation isn't as high and when there is opportunity going forward. So that's just a little bit of backdrop on the market and where we came from, and we'll pass things back to Kathleen and Frank for the next section.
So I'm going to ask Frank to turn on his mic and video, and as we begin his portion, we're going to start again with a polling question for you. I'm going to launch it now. And as Krista was mentioning, it doesn't show up the polling on our recording, so I'll just read it out. Where do you believe the most promising investment opportunities lie in equity markets for the remainder of the year? Technologies benefiting from artificial intelligence investments, biotech, healthcare sectors, traditional oil and gas, emerging equity markets, or other. So I'll give you a bit of time to answer before I surprise Frank with results, and he can take that into his presentation. So I'll give you a little bit more time. People are answering, so that's terrific. All righty, I'm about to end the poll. So here we go. I'm ending the poll, and I will share the results. So Frank can comment on this.
So I'm not totally surprised. I think the overwhelming amount of responses are technologies benefiting from AI had the bulk of the responses, and then I think followed by biotech and technology that got to receive a quarter, and then obviously traditional oil and gas companies got 16% of the vote. So really reflective of the recent market activity, where obviously we've had some very significant gains in both technology and also healthcare. But we have two topics that we want to share with you today that we believe are relevant in the current environment, in which I think we've seen meaningful gains in a concentrated number of asset classes, sectors, and companies. Granted that, as Krista highlighted, we've seen market leadership starting to broaden recently. We continue to believe investors should be avoiding being complacent about investment risks embedded in their portfolio and continue to seek out the diversification opportunities. I think the potential impact of AI, which was a topic we highlighted in our webinar series a year ago, has definitely captured the attention of investors, and it's basically really influenced markets over the last year. The US, I think, is at the forefront of adopting AI, and it's no surprise that US equities have far outperformed every other region in the world. And companies in the communication and technology sectors have performed extremely well. And NVIDIA has suddenly become a household name after its shares have more than tripled in value over the last year. So we believe that the adoption of AI has the potential to really transform the global economy and the way we work. And we noted a recent study from Price Waterhouse that estimates that AI adoption potentially can contribute $15.7 trillion to the global economy by 2030. So that's a substantial amount, given the size of the global economy is just north of 100 trillion. That's a pretty significant contribution. So, I mean, as investors, we want to ensure portfolios can capture the value created from AI adoption. However, we believe investors should not be, isolating the portfolios to this one theme. So, in our first topic, we'll try to make the investment case for diversifying equity portfolios beyond the Magnificent Seven, and why investors should be considering exposure to global small cap companies. The second topic will highlight the major tailwinds derived from a surge in infrastructure spending expected over the next decade, and how investors can participate on that theme. So let's dive into our first topic. Equity markets experienced a pretty significant drawdown in 2022, and in the first 3 quarters were down 20% before troughing in October. But since then, we've seen a pretty dramatic recovery in equity prices as I guess the concerns about an economic recession kind of faded as 2023 materialized. This chart captures the returns from various equity markets from the market lows in October 2022 to the end of the first quarter. The first observation that I capture from this chart is that equity regions, all benefited from a recovery in prices, but there was some divergence. U.S. equity markets are up 47%, while international developed markets are not far behind at 43%. But as you can see, weak Chinese equities have weighed on emerging markets that have only rallied by 21% since October 2022. The second observation is that there's been a great deal of divergence within the U.S. equity market in itself, as the largest companies have experienced the biggest price gains. So for this reason, you'll note that the S&P 500, that is an index weighed by market capitalization, has generated a 47% return, while the S&P Equal Weight Index is up only 32%. So that those big companies are really driving the U.S. equity market higher, and that's why you're seeing that 15% differential between the S&P 500 and the Equal Weight, which is a pretty wide differential if we look at historical terms. I think the third observation is just how strong the returns have been for the Magnificent Seven, that collectively have rallied by 121% since the market bottom. I think when we look at these companies, we attribute massive outperformance to a number of factors. I think first and foremost, it's these companies have delivered stellar earnings growth, and they all represent excellent businesses that have very attractive growth potential. But there's also, I think, a second factor that these companies have generated a great deal of investor enthusiasm over the last year. I think a lot of it is driven by the potential gains from AI, and the likes of Alphabet, Microsoft, and NVIDIA have certainly benefited from higher valuations. I think these higher valuations is why we think investors should not be left mesmerized by the outsized returns being generated by the Mag 7, and instead start to focus other opportunities outside of these market segments where companies have similar growth prospects, but have more reasonable valuations. We believe in the current environment, it really reinforces our philosophy, where there's definitely a benefit of having an equity portfolio that is exposed to multiple equity factors, and not solely to concentrating all your attention to the largest growth companies that have performed so well as of late. So this has caused us to kind of investigate other market factors that have been overlooked by investors, and the size factor is one that's caught our attention. Smaller companies have definitely been negatively impacted over the last 2 years, and I think smaller companies have dealt with challenges tied to rising inflation and higher interest rates. If you move to the next slide, you'll see that the US, both US and developed market indexes, when you compare the returns, you'll notice that while the absolute returns for the Russell 2000 and the MSCI small cap index have been positive, there has been a material underperformance from small caps relative to large caps over the last 3 years. I think part of the reason of the underperformance is captured in the next slide that looks at sector composition between large and small caps. The large cap index is dominated by technology. That makes up 24% of the index, whereas the sector is only 11% of small caps. And while we've seen pretty broad gains in the technology sector, it's been far more impactful for large companies. Small companies have also faced, I think, greater headwinds within financials, as regional banks have had their share prices negatively impacted by credit conditions deteriorating since the start of 2023. However, I think beyond the sector composition impact, I think smaller companies have been operating in a tougher environment over the last 2 years. And on the next slide that we have, which is from JP Morgan, it illustrates the pressure on profit margins that smaller companies have faced over this period. Yeah, the chart on the left shows that 42% of small companies are currently unprofitable, which is at a similar level to past periods where we've had a degree of economic weakness, notably during the tech wreck in the early 2000s and following the financial crisis in 2008. But notice that there's a smaller portion of large and mid-cap companies that are unprofitable than in past periods of turmoil. I think this partially explains why investors are kind of lackluster. There's just not that same level of interest in small caps. The chart on the right compares financial leverage for different size companies. Again, large companies are generating earnings nearly 8 times the level they need to meet interest expenses, well above historical levels. So their balance sheets are in fine conditions. In contrast, smaller companies are experiencing the strain of higher interest rates that are tied to lending conditions and the fact that a lot of their debt is floating. So there's obviously more of an impact as we've seen a rise in interest rates. Looking forward, if we move to the next slide, we see there's really 4 reasons why we think we're a little more optimistic about global small caps. First, we expect profit margins to improve. I think smaller companies have had their margins greatly impacted by inflationary pressures, supply chain disruptions, and higher interest costs. But I think these pressures are slowly starting to abate. And with lower financing costs, it really positions small caps well to experience a strong recovery in earnings. Currently, analyst expectations align with this view. So analysts are basically expecting Russell 2000 companies to grow earnings by 16% in 2024 versus only 10% for S&P 500 companies. I think the second reason is valuations. They're simply far more attractive for small caps relative to large caps. Since 2000, small caps defined by the profitable companies in the Russell 2000s have traded at a 2% discount to trailing earnings base versus the S&P 500. Currently, that discount is closer to 40%. So that's a significant discount based on historical valuations. The third reason is I think we believe small caps are poised to benefit from fairly strong top-line growth from the industrial sector, particularly in North America, where I think we're going to see sustained spending on infrastructure and the rebuilding of domestic supply chains. Recall that 21% of developed small cap index is composed of industrial companies, many of them generating the vast majority of their revenues from domestic sources. I think lastly, we think small caps can benefit from an upswing in M&A activity as private equity funds step up and deploy capital after a very slow period of deal making in 2023. Dry powder refers to capital committed by private equity investors that has yet to be deployed. And as per S&P Global, at the end of 2023, there was $2.5 trillion in global equity dry powder. So giving a lot of incentive for private equity to kind of bid up the price of, I think, undervalued small caps. There is one caveat we would emphasize in terms of small cap strategies, and that's to emphasize the quality factor. We definitely have a preference for actively managed small cap strategies that select companies with a proven track record of generating high returns on equity. They can consistently increase profits and future cash flows, and that are operating with a low level of leverage. Now, let's move to our second topic, in which we make the case for diversification and the investment opportunities that we believe exist from the growing flow of capital being directed to infrastructure projects. This chart is from Morgan Stanley, and it illustrates the disparity of infrastructure spending as a percentage of GDP by country. And what you'll notice at the bottom, the US is only spending half a percent of GDP on infrastructure in comparison to 10 times that level in China. However, that is changing, as you see from the following slide. Miraculously, the Biden administration and Congress passed both the Infrastructure and Investment and Jobs Act and the Inflation Reduction Act that is expected to invest $1.25 trillion across transportation, energy, and other public utilities over the next 5 to 10 years. The rise in spending to maintain, expand, and improve infrastructure is not only a US phenomenon. As the next slide shows, there's been a meaningful increase in spending globally on the energy transition, with $1.8 trillion spent in 2023 alone, more than 3 times the level that was spent in 2019. So how can investors take advantage of the significant tailwind? Well, there's definitely probably different approaches that investors can take to gain exposure to this theme. We'll focus on 2 for simplicity purposes. I think the first approach is as an alternative investment, where investors can invest in a private infrastructure fund. In this structure, investor capital is raised to assemble a portfolio of private assets, whether that be existing utility or investing in development projects. Private infrastructure investment funds usually require a significant amount of capital commitments, and it's really limited to accredited investors. The appeal of private funds is that asset managers can create value for investors in a number of ways. It could be through the effective use of financial leverage to augment returns, or through their ability to source, operate, and negotiate agreements for assets that can generate, pretty attractive returns. In many cases, the revenues generated from infrastructure assets are linked to inflation. Therefore, they provide an excellent support to portfolios in periods where we're seeing higher inflation. And typically, these assets have a low correlation to traditional assets that simply don't have the same characteristics. I think the drawbacks to private infrastructure is that it does require investors to have a very long holding period that usually extends into at least a decade, and with limited liquidity during that time period. The competition is also fairly intense, with institutional investors such as pension funds, sovereign funds, and endowments all in competition for the same assets. So it puts a lot of pressure on high net worth investors to generate those attractive returns. I think lastly is management fees are typically higher as there's significant expenses associated with assembling a team capable of managing these very unique assets. I think the second approach would be to investing in publicly traded companies that have businesses tied to the broader infrastructure sector. This ranges from owning utilities and natural gas pipeline companies to the engineering and construction firms that are steering many of these large projects. I think the appeal of the public approach is that it provides excellent liquidity, and investors are not required to hold the investments for long periods of time. The approach is also quite accessible and doesn't require a large capital commitment from investors. I think the drawbacks for investors are that you're really exposed to market risks and the volatility associated with public investments. And then at the same time, I think investors are not really getting direct exposure to stable, inflation-protected revenue streams from infrastructure assets. I think, in addition, although astute asset managers can add value through security selection, there's definitely fewer levers for fund managers to augment returns for investors. There's no effective use of financial leverage, and there's no direct control on the infrastructure assets. From our perspective, our client portfolios have had exposure to both private and public infrastructure. We believe the investment team will continue to present opportunities, and our investment committee is continuously looking at opportunities where we can invest in both private and public forms. We hope the topics today have helped shed some light on considerations for your portfolio, and I'll pass it back to Kathleen for questions.
Great. I'm going to thank both Krista and Frank for your presentations, and I'm going to ask you to turn on your video mics, which I see you do, and I'm going to stop sharing the presentation here, and I'll turn on my video as well, and we'll see what the questions we have. So I have a first one for you, just dealing with the Magnificent Seven. So the question is, how might an investor shift away from the Magnificent Seven impact with portfolio diversification? So maybe I'll throw that to you, Frank or Krista, which one?
I think Frank talked about some of that. I mean, I think it's not that we don't think there's opportunity in those stocks. I mean, you think of the first quarter, NVIDIA was up 85.7% or 87.5%, whichever way that was. So there's certainly a strong support for artificial intelligence and that theme, and we're not completely walking away from it. But I think the idea is that there are some other segments, sectors in the economy and other geographies that haven't yet had that lift. So so the idea that there are some opportunities there, and Frank has highlighted, you know, that global small cap could be a way to look at it. But I think, you know, sometimes I think our portfolios are quite well diversified because we have a number of different managers looking at different sectors. But sometimes when we meet someone, they might mainly have North American equity and have quite a big amount of US large cap stocks. And so that's where I think it's good to look at what other opportunities are there to broaden across other sectors and to introduce some of those other ideas without walking away from it overall, because I think there is some continued opportunity in those well-run companies with strong balance sheets and good theme, you know, with AI. I think on the AI side, though, certainly there'll be that artificial intelligence will help other companies beyond technology companies to get more productive. So again, there's going to be some opportunities outside of just those large stocks.
Yeah, no, that's those are some interesting insights there. And on that, when a question just came up with asking about, you know, as an investor, how do they identify and measure the value of the diversification in their portfolio? What's one way they can look at that and understand that better?
Well, I mean, obviously, you kind of look at portfolios and you say, well, what are the what sectors are you exposed to? What asset classes are you exposed to? What top holdings? What do they represent in your portfolio? Obviously, when you're seeing a lot of it concentrated in one asset class or a handful of sectors or a handful of securities, obviously there's just concentration issues. There's obviously there are diversification issues, and that's where you kind of have to address it. I think portfolios over the last 5 years are probably kind of if they've been left untouched, are dealing with these issues. These companies become large in size. You know, if you look at the Magnificent Seven, they represent, you know, almost 30% of the S&P 500. That's a big share. So you know, those are some signs. You know, when you're kind of limited to certain investments, those are signs that, you know, you need to kind of review your holdings and you review your positioning.
Okay. Well,
I think it's partially, you know, if you look at the reporting for your portfolio from whoever's managing it, you want to look at what asset classes do I have? You know, do I have some fixed income? Do I have equities? What geographies do I have? What size of companies? Is it all large cap, or do I have mid and small cap? What sectors and am I invested across? Am I very heavily weighted in one sector? So those are ways you can look at your portfolio, and then positions, you know, to Frank's point, are you getting concentrated in either sectors or positions? And then I think what that diversification can bring is a better risk adjusted return. So, you know, it is nice to be in that top performing sector and get the highest returns, but you also want to look at the volatility and you know, what kind of variance you're having in your returns. So that's a discussion to have with your manager in terms of, you know, how to measure the impact of broadening that investment.
Yeah, no.
distribution.
Yeah, that's interesting. Yeah, an important thing to keep an eye on, I would think, as an investor too. Should be watching that, especially with the results with the past year. So I have one other one, another one that just came up. This is an interesting one, and I'm curious to hear your answer to this. You know, especially given some of the challenges, how important is it to really stay fully invested during, you know, market uncertainty? And maybe this is answering some of the other questions, but what strategies can they employ to mitigate the risks during this volatility?
Yeah, I mean, I
Frank
think,
or-
you know, they often say, you know, time in the market is worth more than timing the market, you know, so staying
Right.
invested can really provide better returns over a long-term period of time, but you need to have a mix in your portfolio that allows you to feel comfortable being invested. So if you've got too much in higher risk positions that makes you really nervous as things are volatile, then you need to adjust your mix to make you feel comfortable. So I think some of the things we look at it, you know, if you've got spending needs, you want to make sure you've got enough access to liquidity so you don't have to sell at the wrong time. So making sure your advisor is talking to you about what your needs are going forward, having either some cash or short-term bonds that allow you to meet those needs without being worried about volatility. And then the asset mix to withstand that. And then just to, I think what we were talking about before, that diversification across positions should help to reduce the variance that you're seeing in the portfolio and help you feel more confident being invested. I don't know if you want to add anything to that, Frank, or?
No, I mean, I think time in the market has been something that, if you look at market history, is what creates a lot of value for investors. And there's always going to be something that kind of gets you offside and wants you to kind of be in something safer. But you know, if that's why I think your point, Chris's point of having that portion of liquidity should be always the focal point. And then any capital that you don't really need for short term should be invested in something that it really matches your longer term objectives. And obviously there's always going to be something to worry about. I think a couple of years ago was really inflation. I think now geopolitics is coming to the forefront. I think it's going to stay with us for some time. But you know, it's proven to be, you know, staying invested is proven to be the best way to approach it.
Right. So I have a kind of a two-part question related to small cap. So one question is asking a little bit about the small cap managers that Kerr currently works with, and then secondly, how do you build in small cap into your portfolio as a strategy?
Yeah, I think sorry, I don't know if we want to get into the specific names of managers we use, but
Right.
you know, a global small cap manager that we use a lot within our global equity mandate. And then we have a couple of other Canadian small cap managers, and we can talk specifics with clients if they want. But sorry, go ahead, Frank. I didn't mean to jump in.
No, and it's obviously it's a component of our portfolios, whether that be global equities or Canadian equities. They make up a component of it. They're not the sole.
Right.
So they play one role as providing us exposure to smaller companies that are typically growing at a faster pace. They're kind of innovative in some aspects. They provide us that exposure, which, you know, it's a niche. A lot of the managers that we work with solely focus on small caps. They've got that expertise. That's why we're attracted to having them as a part of our portfolios, and they add that value. Which I think is not something that some of our other managers who are focused on other aspects of the market. So they're really adding component that is unique. And we're looking, like, I think the quality factor is one component that, you know, we really stress across all our portfolios, but in small caps in particular, because financial leverage is an issue, and having that quality component, you know, helps you and reduces the unpleasant surprises sometimes when you invest in smaller companies.
Right. No, that's any other thoughts there, Krista, on that?
No, I think that's it. So we do have a couple of managers that we like. We also have some of our, Canadian equity manager that has holdings across the spectrum, maybe more mid cap than small cap, but they're trying
Right.
to look across capitalizations. We were talking to a manager this morning that we're considering, and they do look at opportunities really. They're sort of agnostic to what size of companies, but they're looking for certain elements in terms of the growth potential and the longevity of growth in those companies. So some of the managers do have the small cap within their mandates, and then we do have a few small cap managers. But to Frank's point, we're looking at that as a component of the portfolio, not
Right.
shifting 100% into those areas.
No, that's interesting. Well, I'm just looking at the time. It's 1 p.m. So just before we sign off, I'll maybe let Krista, Frank, with any closing thoughts before we sign off.
I mean, I guess, we continue as an investment committee to really pay attention to all of these things, to look at all the data as it evolves and think about what it means for our portfolios. But I think what we're really trying to do for our clients is make sure you've got liquidity you need, and then you've got good diversification and good quality managers, and those managers are finding opportunities. So that's something that we're really keeping an eye on in terms of the investment side. I don't know if you want to add to that, Frank, or?
No, absolutely, and to the points that I made this afternoon, I think there's different themes. There's not only one theme, and that's what we're trying to kind of capture in our discussions with managers, making sure that they're completely on board with. I think a pretty exciting opportunity for investors.
Right.
Great. And then just to add, it's beyond the scope of our conversation today, because this is really focused on portfolio management and your portfolios. But obviously, we're aware that the Canadian federal budget came out yesterday, and our tax team is really looking at the proposals that were made in that budget and the impact they'll have on client portfolios. So if any of you have questions about that, please feel free to talk to us. And we're also going to be bringing out some, looking at the impact of those proposals on our clients' tax situations, as well as we look at your integrated wealth management.
Well, that's great. Well, thanks. Well, thank you, Krista and Frank. That was really informative, and I really appreciate it. And thank you to everybody who tuned in today. We'll be sending out a follow-up email, and if you have any comments or questions, do feel free to reach out to either your advisor here or to myself with any of your questions, and we'd love to hear from you. Thanks so much.
Thanks very much, everybody.
Thank you.